The price of gold fell hard on that vaccine announcement, down more than 5% on the day, the 12th worst single day drop in more than 16 years. But is it too early to count out gold as an investment for 2021? In this video, I'll show you the fundamentals and the history for investing in gold next year, then reveal the 5 best gold stocks I'm watching to buy. We're talking gold investment today on Let's Talk Money. Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel. I want to send a special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, gold has been the runaway investment this year, with the price up 25% since recommending it in our video on March 20th. As a hedge against market fears and inflation, the price of that yellow metal has just surged. The price plunged earlier this month though, with news of a vaccine dropping 5% in a single day, the 12th worst daily loss in nearly 2 decades. But the good news for gold investors is that when the price has fallen so quickly in a single day, it's rebounded an average of 3.5% within the next 3 months, and twice has broken out to 15 and 23% higher. And while a lot of the uncertainty has come out of the market, the election is behind us, a vaccine looks like it's going to be out soon, there could still be a lot coming, and the fundamentals are pointing to higher prices for gold. In this video, I'll show you why gold could still make a run for 2021 and why you should consider having some of it in your portfolio. I'll show you how to invest in gold and reveal the 5 gold stocks I'm watching right now. Now, before we get started though, I wanted to get your opinion on this. What's your favorite way to invest in gold? Are you buying that physical gold bullion or the coins? Maybe that gold ETF? Or do you just prefer the shares of the gold miners? Scroll down and let us know in the comments which one do you prefer investing in and why. Nation, despite some of that risk coming out of the market, we're not exactly in the clear for 2021. Even with an emergency authorization on the vaccine, there won't be widespread distribution anytime before March. We still have over 10 million people unemployed, and the risk to a double-dip recession is still very much a possibility. Now, besides this economic risk, the fundamentals behind the price of gold are extremely positive. Central banks have been buyers for over 10 consecutive years, and 2018 saw the largest purchases since Nixon closed the gold window in 1971. Now that's a long-term trend and something that will probably only increase as countries like Russia and China try to diversify their holdings away from the dollar. Gold held by ETFs grew by over 400 tons last year to a record of almost 2,900 tons, and investor demand picked up on that global uncertainty. Now, gold demand in tech products has also risen consistently, and it's really only in the jewelry component that we've seen any kind of weakness. And nation, with the government throwing nearly $10 trillion at the pandemic in less than a year, there's a good bet that inflation spikes later next year really puts a floor on that support under gold. And we've talked about investing in physical gold in the past, and I've used apps like Vaulted, but it's harder to make money on these because of those costs. Even on cheaper apps out there, you're still paying 2% plus for each transaction. That's buying and selling, which means you need to see prices higher by about 5% just to break even. For its part, the Spider Gold Shares ETF, that's ticker GLD, gives you cheaper access to physical gold holdings, but it's still going to cost you that 0.4% annually, and you're going to make no money until you sell it. Now that's why I really like investing in gold stocks better. The miners pulling it out of the ground, not only do you get that dividend yield on your money, but the miners are going to be leveraged businesses, which means you can outperform the return on gold as it rises. In fact, the Vectors Gold Miners ETF, that's ticker GDX, has jumped 34% since recommending it in last year's gold video. Now the GDX Gold ETF is going to give you that broad exposure to the companies in the space, but I don't think it's your best bet here either. I like the individual gold companies because you're able to pick the best of the best here, and I found 5 gold stocks that should be on your radar. First here is IAMGOLD, ticker IAG, a smaller miner but possibly my favorite of the group. IAG has 4 operating mines, 5 in advanced exploration, and equity interest with exposure in Canada, Latin America, and Western Africa. And there is a lot to like about IAMGOLD here, from its production history and reserves to valuation multiple. The company has led the industry with 101% growth in its reserve base over the 7 years to 2019. Proven and probable reserves, the amount of estimated gold in its fields is nearly 17 million ounces. That's the 3rd highest among smaller miners And the valuation here on the shares is the lowest in the industry at just $102 per reserve ounce. The company has a production target of 1.3 million ounces through 2024, backed by a strong pipeline of exploration and development. The all-in sustaining cost here, that per ounce cost to run the company, is around $1,200 an ounce, and not the lowest in our 5 gold stocks, but very competitive also. This next one is an interesting play and a 1.6% dividend yield. $10 billion Sebanye Stillwater, ticker Sbsw. Now, Sebanye is not a pure play gold producer, with just over 2/3 of its production in that platinum group metals. It produces out of 15 projects across North America and South Africa, with about 1/5 of its revenue coming from gold. Palladium accounts for 43% of its revenue and 28% of production, and has seen prices jump 138% over the last 3 years, nearly 3 times that increase in gold prices. Management is targeting 30,000 kilograms of gold production this year and 2,000 kilo ounces of the platinum group metals. Now, the company is producing at an all-in sustainable cost of $1,480 per ounce, which is fairly high, but it was at $1,170 per ounce last year before the pandemic hit, and I think it can get back to that level again next year. That's going to improve the fundamentals, and as a bonus on Sebanye here, it owns a 44% interest in the Rand refinery, which markets gold to global customers. So along with that upstream miner, you get that exposure to the retail side of the market as well. I first recommended Eldorado Gold, ticker EGO, in May of last year at $3.72 a share. And even after a 276% run in the stock, I still like EGO as one of the best opportunities in gold stocks. Now, the miner focuses on 5 operating mines in Canada, Greece, and Turkey, with developmental projects in Latin America and Eastern Europe. Those fields in those developing markets have helped it keep the costs down, but have also added an element of geopolitical risk in the past. The company had to fight the Greek government for years just to win permitting and licenses, and it's still trying to reach an agreement on its Skouries fields. Even without that, though, the company has several catalysts for production, including the study on the Lamaque mines for finalized targets. Production is forecast to 550,000 ounces this year, with proven and probable reserves at 17.5 million ounces, along with sizable deposits of silver and copper. Now, Eldorado is one of the lowest costs in the industry at an AISC of just $902 per ounce, less than half the current market price. Because of those geographic risks, though, EGO regularly trades at one of the lowest valuation in miners. Right now, that's about 0.6 times its net asset value. The company has a great balance sheet with $435 million in cash against just $600 million in total debt, so a lot of financial flexibility here as well. Gold Mining Inc., ticker GLDLF, is a riskier play for its size, but shares are up 37% just since our August interview with the CEO. This company has a pipeline of development projects in North and South America with 11.4 million ounces of measured and indicated resources. Now, that's not the same as that proven and probable measure you get with the miners that are already in production, but it's a fair estimate for targets. What I liked about Gold Mining Inc., though, was its aggressive acquisition strategy when gold prices were lower, buying up assets for just $81 million over the last decade. Those are assets now worth upwards of $850 million at $2,000 per ounce gold. Now, this is a junior miner, so riskier than the others on the list, but also a lot of upside potential here. For gold investors that want maybe a little safer play, Newmont Mining, ticker NEM, is the world's largest gold producer and pays an industry-leading 2.4% dividend. Newmont produces over 6 million ounces of gold annually and has the production pipeline to do it through 2029, so an excellent long-term play on gold. Reserves here top 96 million ounces of gold, the most in the industry, plus 63 million ounces of copper and silver. The company benefits from that size advantage and has been able to lower its all-in sustaining cost to just $1,000 an ounce and is forecasting it lower to just $850 an ounce over the next few years. It's just hard to argue with success here. Newmont has returned over $2 billion in dividends and buybacks over the last 18 months and has produced a 4-fold return over the last 5 years. Click on the video to the right for our 2021 investing strategy, what I'm watching, and how to invest for the coming year. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.